Before we begin, it's crucial to understand that I am not a licensed financial advisor, and the information provided in this video is for educational and informational purposes only. This presentation is not intended to be a substitute for professional financial advice. You should always consult with a qualified financial professional who can assess your individual situation before making any major financial decisions. All strategies and investments involve risk, including the potential loss of principal. Your home is likely your largest asset, and decisions regarding it should be made with care and professional guidance. There's a number sitting inside the walls of your house right now. It's a secret number, one you probably don't think about every day, but it's grown silently year after year. For millions of Americans, this number has become astronomical, bigger than their 401k, bigger than their savings account, bigger than they ever imagined. It's your home equity. And right now, you might be looking at a leaky roof, a tuition bill that makes your eyes water, or a mountain of high-interest credit card debt. And you're thinking, I'm sitting on a gold mine, but I'm living like I'm broke. How do I get to it? That question, that single critical question, leads you to a crossroads with two paths. Down one path is the mortgage. Down the other, the home equity loan. They sound similar. Your bank might even present them as basically the same thing. But they are not. Choosing the wrong path isn't just a simple mistake. It's the kind of mistake that can cost you tens of thousands of dollars in unnecessary interest, lock you into a decade of financial inflexibility, and in the worst-case scenario, put the very roof over your head at risk. A recent survey showed that nearly half of all homeowners who tap into their equity couldn't clearly explain the terms of the financial product they used. They signed the papers, took the cash, and just hoped for the best. We are not going to do that. In this video, we are going to arm you with the knowledge to make this decision with absolute confidence. We're going to dissect these two financial giants piece by piece in plain, simple English. By the time you're done watching, you will understand exactly how each one works, their hidden pros and cons, and you'll be able to identify with surgical precision which tool is the right one for your specific financial goal. This isn't just about learning definitions. It's about taking control of your single biggest asset and making it work for you, not against you. So let's start at the beginning with the one we all know, or at least think we know, the mortgage. Think of your original mortgage as the key that first opened the door to your house. It's the foundational loan. It's the granddaddy of all home financing. You found a house you loved, it had a sticker price that was, let's be honest, a terrifyingly large number, and you went to a lender who agreed to front you that massive pile of cash. In exchange, you promised to pay them back with interest over a very long period of time, usually 15 or 30 years. That entire loan, the one you got to buy the house, is a mortgage. Its purpose is acquisition. Its job is to get you into the property. The mechanics are straightforward. The total amount you borrowed is called the principal. The fee the lender charges you for the privilege of using their money is the interest. Every single month, you make a payment that's a combination of both. In the early years of your loan, that payment is almost all interest. You're mostly just paying the bank for the loan itself. But slowly, like a seesaw, the balance shifts. Over time, more and more of your payment goes towards chipping away at the principal, the actual amount you borrowed. This process is called amortization, and it's how, after 360 payments on a 30-year loan, you finally own the house free and clear. The house itself is the collateral. If you stop paying, the lender can take the house. It's the ultimate security deposit. Now, this is where a lot of people get confused. They think mortgage is just one thing, but there are different flavors. The most common is the 30-year fixed-rate mortgage. This is the bedrock of American homeownership. It's predictable. Your interest rate is locked in on day one, and your principal and interest payment will be the exact same amount for the next 3 decades. It doesn't matter if the economy soars or crashes, your payment remains the same. It's the slow, steady, reliable minivan of the financial world. Then you have its slightly more adventurous sibling, the 15-year fixed-rate mortgage. You pay it off in half the time, which means your monthly payments are significantly higher, but you build equity like lightning and you pay way less in total interest over the life of the loan. And then there's the wild card, the adjustable rate mortgage, or ARM. This is where the interest rate isn't fixed. It typically starts with a lower introductory teaser rate for a few years, making it look very attractive. But after that initial period, the rate adjusts based on the market. If rates go up, your payment goes up. If they go down, it goes down. It's a gamble. You're betting that rates will stay low, or that you'll sell the house or refinance before the rate adjusts upwards. It's this type of mortgage that got a lot of people into trouble back in the 2008 financial crisis. So that's the mortgage in its purest form. a massive long-term loan used to purchase a property. But here's the key. For years, you've been diligently making those payments. You've been chipping away at that principal. At the same time, the housing market has been on a tear. The house you bought for $300,000 might now be appraised at $500,000. You've paid your loan down by $50,000, so you only owe $250,000. But the house is worth $500,000. The difference between what your house is worth and what you owe on it, in this case $250,000, that's your equity. It's your wealth. It's the value that you own. And it's just sitting there, trapped inside the drywall and the foundation. This is the exact moment the entire conversation changes. You're no longer trying to buy a house. You already own it. Now, you want to use the value you've built in that house to solve another problem. Maybe you want to consolidate $20,000 in credit card debt that's strangling you with 22% interest. Maybe you want to do a $75,000 kitchen remodel. Maybe you need $50,000 for a down payment on an investment property. You need a lump sum of cash. You can't just walk up to your house and pull cash out of the wall. So you go back to the bank. And this is where the second contender steps into the ring, the home equity loan. It's also a loan. It also uses your house as collateral. But its purpose, its structure, and its entire reason for existing is fundamentally different from that original mortgage. It's not about buying the home. It's about borrowing against the portion you already own. And understanding this distinction is the first, most critical step to making the right choice. Because while a mortgage is the key that gets you in the door, a home equity loan is the tool that can help you build new rooms, or if used improperly, could accidentally knock down a supporting wall. So let's start with the mortgage. And to truly understand it, I want you to forget the word loan for a second. Instead, think of a mortgage as a 30-year financial marriage. It's a long-term, legally binding partnership between you and a lender. You both have a shared interest, your home. But you have very different roles. Your role is to live in it, love it, and most importantly, pay for it month after month, year after year. The lender's role? To hold the deed, the legal title to your home, as collateral until you've made that very last payment. If you hold up your end of the bargain for 360 months, they'll hand over the deed, the marriage is complete, and you own the house free and clear. But if you break your vows, if you stop making payments, they have the right to initiate a very messy and public divorce called a foreclosure. This is the fundamental nature of a mortgage. It's what's known as a purchase money loan. You are using this money for one specific purpose, to buy the property. You don't get a check to go spend on a vacation or a new car. The money goes from the lender through a complex process called escrow, directly to the seller of the home. You are just the catalyst, the person who makes the transaction happen. Now, inside this financial marriage, there are two main characters who are always battling for your attention: principal and interest. The principal is the hero of our story. It's the actual amount of money you borrowed to buy the house. If you bought a home for $400,000 and put down $50,000, your principal is $350,000. Every single dollar you pay towards the principal is a dollar of the home you are actually buying back from the lender. It's you planting your flag, claiming a tiny bit more of your territory each month. But the principal doesn't get to travel alone. It has a constant and very expensive companion, interest. Interest is the price of admission. It's the fee the lender charges you for the privilege of using their $350,000 for the next 30 years. It's pure profit for the bank. And here's the part that trips up so many people. In the early years of your mortgage, the vast majority of your monthly payment is going straight to interest. It's a brutal front-loaded system. Imagine your monthly payment is $2,000. In the first few years, maybe only $500 of that is actually going to principal, to buying back your house. The other $1,500? That's just the fee. It's vanishing into the lender's pocket. It can feel like you're running on a treadmill, sweating and working hard, but barely moving forward. But slowly, painstakingly, the balance begins to shift. As you chip away at the principal, the amount of interest you owe each month decreases. So, 10 years in, maybe your $2,000 payment is now $1,000 for principal and $1,000 for interest. 20 years in, it might be $1,500 for principal and only $500 for interest. This slow, epic journey of shifting payments from mostly interest to mostly principal has a name: amortization. It's the pre-written script of your 30-year financial marriage, and understanding it is the key to knowing where your money is actually going. Before you can even get approved for this marriage, the lender is going to put you through a rigorous vetting process. They want to know if you're a reliable partner. They'll look at 3 critical things. First, your credit score. Think of your FICO score not as a number, but as a financial trust score. It's a single number that tells the story of how you've handled debt in the past. Have you paid your bills on time? Do you carry a lot of credit card debt? A high score, typically above 740, tells a lender you're a trustworthy, low-risk partner. A low score tells them you might be a bit of a financial wild card, and they'll either deny you or charge you a much higher interest rate to compensate for that risk. Second, they'll scrutinize your income and employment history. They want to see stability. They want to know you have a reliable stream of cash coming in, not just this month, but for the foreseeable future. They're not just marrying you for who you are today. They're betting on who you'll be for the next 3 decades. And third, they'll calculate your debt-to-income ratio, or DTI. This is one of the most important metrics in the lending world. All it does is compare how much money you make each month to how much money you're obligated to spend on debt payments, car loans, student loans, credit cards. Imagine your income is a bucket of water. Your DTI is the measure of how many holes are already in that bucket before you even add a mortgage payment. Lenders want to see a DTI below 43%, meaning less than 43% of your pre-tax income is already spoken for. They need to be sure there's enough water left in the bucket to handle the giant new hole they're about to add. Now, assuming you pass this financial background check, you're faced with the first major choice in your mortgage journey. What kind of mortgage do you want? This is where things get really interesting. The most common type, the one your parents and grandparents probably had, is the 30-year fixed-rate mortgage. This is the bedrock of American homeownership. It's predictable. It's stable. It's boring in the best possible way. The fixed-rate part means your interest rate is locked in for the entire 30-year term. If you get a rate of 6.5% on day 1, you will still have a rate of 6.5% on day 10,950. It doesn't matter if the economy booms or busts, if inflation goes to the moon or the Federal Reserve raises rates to 20%. Your rate is set in stone. This provides incredible peace of mind. Your principal and interest payment will never, ever change. You know exactly what it will be this month, next year, and in 2054. But there's another path. A more adventurous and potentially more dangerous one, the adjustable rate mortgage, or ARM. An ARM is a shapeshifter. It lures you in with a low introductory teaser rate, which is often significantly lower than what you could get on a fixed-rate loan. This initial period might last for 5, 7, or 10 years. During this time, your monthly payments are lower, and you feel like you've outsmarted the system. But here's the catch. Once that introductory period ends, your interest rate adjusts. It starts to float based on the broader market interest rates. If rates in the economy have gone up, your mortgage rate goes up, and so does your monthly payment. Suddenly, that affordable payment could skyrocket by hundreds or even thousands of dollars. Now, ARMs have safety features called caps that limit how much the rate can change at one time and over the life of the loan. But the risk is still very real. An ARM is a bet. You're betting that you'll either sell the house or refinance before the adjustment period hits, or you're betting that interest rates will be lower in the future. It can be a powerful tool for the right person. Someone who knows they're moving in a few years, or a high-income earner who can absorb the potential payment shock. But for most first-time homebuyers, it's like trying to navigate a minefield. The stability of the 30-year fixed-rate mortgage is almost always the safer, wiser choice. So you've chosen your path. You've signed a mountain of paperwork that feels like it was printed on lead. You've survived the closing. The keys are finally in your hand. You walk through the front door of your home for the first time. The journey is over, right? Wrong. The journey is just beginning. Because with that first mortgage payment, you didn't just buy a house. You started building something else. Something invisible but incredibly powerful. You started building equity. And that, my friends, is the resource that unlocks an entirely new world of financial possibilities and potential pitfalls. It's the key that turns your home from just a place to live into a financial tool you can actually use. So let's bring this to life. Imagine a couple, we'll call them Mike and Jessica. They bought their first home 7 years ago for $300,000. It was a classic starter home, good bones, but the kitchen was a time capsule from the 1980s and the master bathroom felt more like a closet. For 7 years, they diligently made their mortgage payments, every single month on time. They weathered a promotion at work, the birth of their first child, and a leaky roof they had to fix. Through it all, that mortgage payment was a constant. Over those 7 years, 2 incredible things happened. First, their mortgage balance, the amount they still owed the bank, started to shrink. They had paid off a chunk of the principal. Second, the housing market in their neighborhood did what it does best over the long term: it went up. Their little starter home, the one they bought for $300,000, was now appraised at $450,000. One evening, while trying to cook dinner in their cramped, laminate countertop kitchen, Jessica has an idea. What if we finally did it? She asks. What if we finally renovated this kitchen? And the bathroom? Mike's eyes light up, but then reality sets in. They start getting quotes from contractors. The dream kitchen, new cabinets, quartz countertops, an island where their daughter can do her homework, plus a modern spa-like bathroom. It's going to cost around $80,000. They don't have $80,000 sitting in a savings account. Who does? Their first thought is a personal loan, but the interest rates are eye-watering. They think about putting it on credit cards, and they both immediately shudder at the thought of that 25% APR. They feel stuck. They have this valuable asset, their home, but the value feels trapped, like money behind a pane of glass they can't break. And this is the exact moment where our first major financial tool comes into play: the home equity loan. Think of it this way. Mike and Jessica's home is worth $450,000. They still owe $240,000 on their original mortgage. The difference, that $210,000, is their equity. It's the portion of the home they truly own. A home equity loan allows them to borrow against that ownership. It's often called a second mortgage because, in essence, that's what it is. It's a second, separate loan that uses their house as collateral, sitting right alongside their primary mortgage. So, they go to their local credit union. The loan officer explains that they can't just borrow the full $210,000 of their equity. Banks need a safety cushion. They use something called the loan-to-value ratio, or LTV. Most lenders will allow a combined LTV of up to 85%. Here's the simple math they do for Mike and Jessica. They take the home's value, $450,000, and multiply it by 85%. That gives them $382,500. This is the absolute maximum total debt the bank wants to see against their house. From that number, they subtract the amount Mike and Jessica still owe on their first mortgage, which is $240,000. The result? $142,500. This is the maximum amount they could potentially borrow with a home equity loan. Their dream of an $80,000 renovation is suddenly, astonishingly, within reach. The defining feature of a home equity loan is that it's delivered as a single, one-time lump sum. If they're approved for the $80,000, the bank cuts them a check for $80,000. All of it right then and there. This is perfect for their situation. They can pay the contractor his deposit, buy the appliances, and cover all the costs of the project without having to juggle finances. They get the money, they do the project. Simple. The second key feature, and this is a big one, is that a home equity loan almost always comes with a fixed interest rate. Let's say they lock in a rate of 7.5%. That rate will be 7.5% on day one, and it will be 7.5% 10 or 15 years from now when they make their final payment. This provides an incredible sense of stability and predictability. They know exactly what their payment will be every single month. It won't fluctuate with the stock market or the Fed's latest announcement. They can build it into their budget and count on it. For a family trying to manage their finances, that peace of mind is priceless. And because the loan is secured by their house, a very solid piece of collateral, that 7.5% interest rate is vastly superior to the 15% they might have gotten on a personal loan, and it's an absolute world away from the 25% on a credit card. They're using the value of their home to access cheaper money. So Mike and Jessica are ecstatic. They can get all the money up front, the payment will be predictable and fixed, and the interest rate is reasonable. Seems like the perfect solution. But then the loan officer sits them down to talk about the other side of the coin, the risks. And the number one risk is monumental. It's the reason the interest rate is so low. The loan is secured by their house. This isn't like defaulting on a credit card, where you get nasty calls from collectors and your credit score gets trashed. If they fail to make the payments on this new second loan, the bank can foreclose on their home. The home where their daughter is growing up. The home with the leaky roof they fixed together. The stakes are as high as they get. They would not only lose the house, but also every dollar of equity they had painstakingly built over 7 years. This forces them to have a serious conversation. They look at their monthly budget. They have their primary mortgage payment of, say, $1,800. The new home equity loan payment for $80,000 over 15 years would be about $740 a month. Can they comfortably afford their life plus their mortgage plus this new $740 payment every single month for the next 15 years? What if one of them loses their job? They have to be brutally honest with themselves about their financial discipline and job security. The second consideration is the cost. Getting a loan isn't free. Just like with their first mortgage, there are closing costs. There might be an application fee, an appraisal fee to confirm the home's value, title fees, and an origination fee. These can add up to several $1,000s, either paid up front or rolled into the loan itself. It's a real cost that eats into the money they receive. So the home equity loan is a powerful tool, but it's a double-edged sword. It offers a lump sum of cash at a fixed, reasonable rate, making it ideal for huge, one-time projects like a renovation, consolidating high-interest debt, or paying for a major medical expense. But it comes with the immense responsibility of a second monthly payment and the ultimate risk of losing your home if you can't keep up. After a week of discussion, Mike and Jessica decide they can handle it. The renovation will add value to their home, and more importantly, to their family's daily life. They're confident in their budget. They're ready to accept the risk. They call the loan officer to move forward. But just as they're about to commit, the loan officer asks them a simple question that changes everything. He says, "You need $80,000 for the whole project, but you don't need it all on day one, do you? You'll pay the contractor a bit now, then more in a few months, and the final amount when the job is done. So why would you want to take out all $80,000 today and start paying interest on the full amount immediately?" Mike and Jessica look at each other. They hadn't thought of that. Is there a way to access that equity but more flexibly? A way to use it more like a credit card, only taking out what you need when you need it? And that question, that leads us directly to the other side of the home equity universe. It's a tool that offers flexibility and freedom that a home equity loan can't touch. But it comes with an entirely different set of rules and its own unique dangers. This tool is called a home equity line of credit, or HELOC. And if the home equity loan is like getting a briefcase full of cash dropped on your table, one and done, the HELOC is like having a financial faucet installed directly into your wall. You can turn it on whenever you want, take as much or as little as you need, and then turn it off again. It's this access, this on-demand power, that makes it so appealing and so incredibly risky. Let's break down exactly what a HELOC is. It's not a loan in the traditional sense. It's a revolving line of credit, secured by your home. Think of it exactly like a credit card, but with two massive differences. First, the credit limit is huge, potentially tens or even hundreds of thousands of dollars based on your home's equity. And second, the collateral isn't just a mark on your credit report. It's the roof over your head. A HELOC operates in two distinct phases. This is the most critical concept to understand. The first phase is called the draw period. This typically lasts for 10 years. During this decade, your HELOC acts like that financial faucet. Let's say you're approved for a $100,000 line of credit. You need $20,000 for a kitchen remodel. You can write a check or use a special card tied to the HELOC account, and boom, you have $20,000. Your outstanding balance is now $20,000. A few months later, you pay back $5,000. Your balance is now $15,000, and you have $85,000 of available credit to use again. A year later, the roof starts leaking. You need another $12,000. You draw it. Now your balance is $27,000. During this entire 10-year draw period, you can borrow, repay, and borrow again, up to your credit limit as many times as you want. It's ultimate flexibility. And here's another feature that draws people in. During that draw period, lenders often only require you to make interest-only payments on the amount you've borrowed. So if you've borrowed $30,000 at a 6% interest rate, your minimum monthly payment might only be around $150. Feels incredibly affordable, deceptively affordable, because all you're doing is treading water. You're not paying down a single penny of the actual money you borrowed. You're just servicing the debt. But what happens when those 10 years are up? The faucet gets shut off permanently. You can't borrow any more money. This marks the beginning of the second phase, the repayment period. Now, that credit card you've been using is effectively cut up. Whatever balance you have outstanding, let's say it's $50,000, is converted into a traditional loan. You'll spend the next 10, 15, or 20 years paying back that $50,000 plus interest. And this is where the first of two major shocks can hit. Your payment amount will skyrocket. That small, manageable interest-only payment you've been making for years is gone. Now you're paying both principal and interest. That $150 payment could easily jump to $400 or $500 or more overnight. It's a financial cliff that far too many people stumble over because they only focused on the low payments during the draw period. But that's not even the biggest danger. The true serpent hiding in this financial garden is the interest rate itself. Unlike a fixed-rate mortgage or a home equity loan, the vast majority of HELOCs have a variable interest rate. This means your interest rate is not locked in. It's tied to a benchmark financial index, usually the prime rate, and it can and will change. When you hear on the news that the Federal Reserve is raising interest rates to fight inflation, that's not just an abstract economic headline. For someone with a HELOC, that's a direct notification that their monthly payment is about to go up. Let me paint a picture for you. Meet Mark and Jessica. In 2021, interest rates were at historic lows. They had $200,000 in equity and decided to get a $100,000 HELOC to finally build that backyard pool they'd always dreamed of. Their initial variable rate was a beautiful 3%. They drew $60,000 for the pool, and their interest-only payment was just $150 a month. Felt like free money. They felt so smart. A year later, they used another $20,000 to take a once-in-a-lifetime trip to Europe. Their balance was now $80,000, but the payment was still manageable. But then the world changed. The Fed began aggressively hiking rates. Their 3% HELOC rate climbed to 4%, then 5%, then 7%. By late 2023, their rate was over 8%. That manageable $150 interest-only payment had ballooned to over $530 a month. They hadn't borrowed another dime, but their payment had more than tripled. And they still hadn't paid back a single dollar of the $80,000 they'd spent. They were trapped. The flexible, low-cost tool that built their dream pool was now threatening to drown them in debt. This is the reality of a variable rate HELOC. You are essentially gambling that interest rates will stay low for the entire life of your line of credit. It's a bet that, as history shows, you are very likely to lose. Now, this doesn't mean HELOCs are inherently evil. Used correctly, they can be a phenomenal tool. The flexibility is their superpower. Imagine a different homeowner, Sarah. She's a contractor who plans to renovate her house room by room over 5 years, doing much of the work herself. A lump sum home equity loan doesn't make sense for her. She doesn't need all the money at once and doesn't want to pay interest on cash that's just sitting in the bank. So she gets a HELOC. She draws $15,000 for the kitchen materials. She pays it down aggressively. A year later, she draws $10,000 for the master bathroom. She only ever borrows exactly what she needs, exactly when she needs it. For her, the HELOC isn't a slush fund for vacations. It's a strategic construction account that minimizes her interest payments and matches her project's timeline perfectly. She is using the tool for its intended purpose, funding staggered, value-adding expenses. So let's line up the pros and cons side by side. The primary advantage of a HELOC is its unparalleled flexibility. You control the flow of money. This makes it ideal for ongoing projects with uncertain costs, for a series of planned expenses like college tuition payments, or as a readily available emergency fund for a true crisis, like a major medical bill or sudden job loss. You only pay interest on what you actually use, and the initial interest-only payments can keep your cash flow free during the project phase. Furthermore, the closing costs on a HELOC are often significantly lower than for a home equity loan, and some lenders even waive them entirely. But the disadvantages are severe and must be respected. The number one risk, as we saw with Mark and Jessica, is the variable interest rate. Your budget can be completely wrecked by economic forces far outside your control. The second major risk is the temptation. When you have $100,000 available at the stroke of a pen, it's incredibly tempting to treat your home equity like an ATM. That line of credit for a new roof suddenly pays for a new car. The fund for a home office gets spent on designer clothes. It encourages undisciplined spending and can quickly turn a valuable asset into a mountain of consumer debt. Finally, there's the payment shock at the end of the draw period. After a decade of small, easy payments, the switch to a fully amortized principal and interest payment can be a brutal wake-up call, especially if interest rates have risen in the meantime. And through it all, remember the ultimate consequence. Your home is on the line. Defaulting on a HELOC, just like any other mortgage, leads to foreclosure. That financial faucet is connected directly to the foundation of your life, and if you let it leak uncontrollably, it can wash the whole thing away. So let's pivot from that flowing, sometimes unpredictable river of a HELOC to its much more solid, predictable cousin, the home equity loan. If a HELOC is a financial faucet you can turn on and off, a home equity loan is a giant block of ice delivered to your doorstep. You get it all at once and it's up to you to manage it, but you know exactly how big it is and exactly how long it will last. This is what people are often talking about when they say a second mortgage. It's a loan, separate from your primary mortgage, that uses your home's equity as collateral. But unlike the HELOC, it's not a line of credit. It's a straightforward, old-fashioned installment loan. You borrow a specific lump sum of money, and you receive it all up front. Then you pay it back over a set period of time, typically anywhere from 5 to 30 years, with fixed monthly payments at a fixed interest rate. The process feels very similar to getting your original mortgage. You'll apply with a lender, they'll pull your credit score, scrutinize your debt-to-income ratio, and verify your income. And yes, they will almost certainly require a home appraisal to confirm the value of the property and, therefore, how much equity you actually have to borrow against. Just like with the HELOC, lenders usually cap the total amount you can borrow at around 80 to 85% of your home's value, minus what you still owe on your primary mortgage. So, if your home is appraised at $500,000 and you owe $200,000 on your first mortgage, your total allowable debt might be 80% of $500,000, which is $400,000. Subtract the $200,000 you already owe, and you're left with a potential home equity loan of up to $200,000. The bank cuts you a check for that amount, and boom, the clock starts ticking on your repayment. The single biggest advantage of a home equity loan, the one that lets people sleep soundly at night, is its predictability. That fixed interest rate is everything. It doesn't matter what the Federal Reserve does. It doesn't matter if inflation spikes or the market goes haywire. Your payment on day 1 will be the exact same as your payment in year 10. You can budget for it down to the penny. There are no surprises, no waking up to an email from your lender announcing that your rate, and your monthly payment, has just jumped by $100. This stability is a powerful psychological comfort. When you're taking on a significant amount of debt tied to your home, the last thing you want is uncertainty. A home equity loan removes that variable from the equation entirely. It's a financial contract with clear, unchangeable terms. The second major benefit is built-in discipline. Because you get the money as a single lump sum, it's tailor-made for a large, specific one-time expense. You're not getting a financial credit card to swipe for a vacation here, a new TV there. You're getting a targeted injection of capital for a predefined purpose. Think about a massive kitchen remodel you've been planning for years. You get quotes, and the total cost is $65,000. You take out a $65,000 home equity loan. The money is for the kitchen. Period. It forces a level of financial focus that a HELOC, with its easy access, open-ended nature, simply doesn't. It prevents what's known as project creep, where a small plan slowly balloons into a massive budget-busting endeavor because the money is just there. This structure is also ideal for debt consolidation. Let's say you've racked up $30,000 in high-interest credit card debt, spread across 3 cards with interest rates hovering around a staggering 22%. You're getting crushed by interest payments, and it feels like you're running on a treadmill, barely making a dent in the principal. You could take out a $30,000 home equity loan at, say, 8%. You use that lump sum to pay off all 3 credit cards in a single day. Instantly, you've vaporized that 22% interest rate. Now, instead of 3 chaotic high-interest payments, you have one single manageable monthly payment at a much lower, fixed interest rate. You have a clear end date for your debt, and you'll save thousands, maybe even tens of thousands of dollars in interest over the life of the loan. It's a powerful strategy for regaining control of your finances. But of course, there's no free lunch. The home equity loan's greatest strength, its predictability, is also the source of its greatest weakness, its inflexibility. That block of ice is a fixed size. What happens if your $65,000 kitchen remodel hits a snag? The contractor opens up a wall and discovers serious termite damage that's going to cost an extra $10,000 to fix. Your home equity loan is tapped out. You can't just go back and draw more money. You'd have to find that $10,000 somewhere else, or potentially apply for an entirely new, smaller loan, which is a massive headache. Conversely, what if the project comes in under budget? You planned for $65,000, but through smart shopping and a little luck, it only costs $55,000. That's great, but you still borrowed $65,000. You now have $10,000 in cash that you don't need, but you are paying interest on it every single month for the entire term of the loan. You can, of course, make a lump sum payment back to the loan, but the structure itself isn't designed for that kind of flexibility. You took the full amount and you owe interest on the full amount from day one. Then there are the costs. While some lenders offer no closing cost options, many home equity loans come with fees very similar to a primary mortgage. You might pay an origination fee, which is a percentage of the loan amount. You'll almost certainly pay for the appraisal, which can be several $100s. There could be title search fees, recording fees, and other administrative costs that can add up to hundreds or even thousands of dollars, all of which are either paid out of pocket or rolled into the loan itself. And finally, we have to talk about the interest rate in context. Yes, it's fixed, which is wonderful. But a home equity loan is a second mortgage. That means it sits in second lien position. This is a crucial concept. In the catastrophic event of a foreclosure, the lender of your primary mortgage, the first lien holder, gets paid back first from the sale of the house. The lender of your home equity loan, the second lien holder, only gets paid with whatever money is left over. This makes the second mortgage significantly riskier for the lender. And how do lenders compensate for risk? With higher interest rates. So, the interest rate on your home equity loan will almost always be higher than the rate on your primary mortgage. It's a trade-off. You get access to cash without refinancing your entire home, but you pay a premium for that privilege. So you're left with two distinct tools, each designed for a different job. The HELOC, a flexible line of credit perfect for ongoing, unpredictable expenses or as a safety net. The home equity loan, a stable lump sum loan perfect for a large, one-time, clearly defined expense. One offers freedom, the other offers security. One is a faucet, the other is a block of ice. But what if you could combine the best of both worlds? What if you need a large lump sum of cash and you want to change the terms of your primary mortgage, perhaps to get a lower interest rate on your entire housing debt? This is where the third major player enters the arena. It's not a second mortgage. It's a total replacement of your first. It's a complete financial reset. I'm talking about the cash-out refinance, and understanding how it works is the key to unlocking the full power of your home's equity. So, how does this complete financial reset actually work? Imagine your mortgage isn't a fixed, unchangeable contract. Instead, think of it as a container holding your home loan. A cash-out refinance is like swapping out that container for a much larger one. You take your existing mortgage, say you owe $200,000, and you replace it with a brand new mortgage for, let's say, $275,000. The new loan pays off the old $200,000 loan completely. It vanishes. In its place is the new larger loan. And that extra $75,000? That's the cash out. It's wired directly to your bank account tax-free, for you to use on whatever you want. It's not a second loan. It's not a side loan. It's one new single larger mortgage that replaces your old one entirely. Let's make this real. Meet Sarah. Sarah bought her home 5 years ago for $350,000 with a 30-year mortgage at a 4.5% interest rate. Over the past 5 years, she's been diligently making payments, and her loan balance is now down to about $310,000. But here's the magic. Her local housing market has been on a tear. A recent appraisal shows her home is now worth $500,000. That's $150,000 in appreciation. Combined with the $40,000 she's already paid down on her loan, Sarah is sitting on $190,000 in home equity. Now Sarah has two big financial goals. First, her kitchen looks like it's straight out of a 1990s sitcom, and she's dreaming of a major renovation that's going to cost around $60,000. Second, she has about $20,000 in high-interest credit card debt from a few years back that's been a constant source of stress, with interest rates hovering around a painful 22%. She wants to wipe it all out in one fell swoop. Total cash needed, $80,000. So Sarah explores a cash-out refinance. She contacts the lender and they start the process. The first step is confirming her home's value. The $500,000 appraisal is key. Next comes the most important rule in the refinancing world, the loan-to-value ratio, or LTV. Most lenders will allow you to borrow up to 80% of your home's appraised value. This 20% buffer protects the lender in case the market takes a downturn. Let's do the math for Sarah. 80% of her home's new value of $500,000 is $400,000. This is the maximum amount her new mortgage can be. So, to figure out her maximum cash out, we take that $400,000 limit and subtract what she still owes on her current mortgage, which is $310,000. The result? $90,000. That's the maximum amount of cash she can pull out of her home. Since she only needs $80,000, she's in a great position. She decides to move forward. She applies for a new mortgage of $390,000. Why $390,000? Because that's her old $310,000 balance plus the $80,000 in cash she needs. At closing, the new loan works its magic. $310,000 from the new loan instantly pays off and eliminates her old mortgage. The remaining $80,000 is wired to her. She now has one and only one mortgage payment on a $390,000 loan. She can immediately pay for the kitchen renovation and wipe out that toxic credit card debt. This brings us to the biggest advantage of a cash-out refinance: simplicity and potential savings. You're consolidating everything into one single monthly payment. There's no separate home equity loan payment to track. But the real home run potential is in the interest rate. Remember, Sarah's original mortgage was at 4.5%? Well, let's say current market rates have dropped, and she can now qualify for a new 30-year fixed rate of 3.5%. This is a game changer. Not only did she get the $80,000 in cash she needed, but she also refinanced her entire original loan balance into a new lower interest rate. She's saving money on the debt she already had while accessing the cash she needed. It's a powerful two-for-one deal that simply isn't possible with other types of home equity borrowing. But, as with any major financial decision, there is a dark side. A cash-out refinance is not a magic wand. It's a tool with significant trade-offs. The single biggest drawback is that you are resetting the clock on your mortgage. Sarah was 5 years into her 30-year loan. She had 25 years left. By refinancing into a new 30-year loan, she's back at the starting line. 30 more years of payments lie ahead of her. Even with a lower interest rate, extending the loan term by 5 years means she will pay significantly more in total interest over the life of the new loan. It's like running a marathon, getting 5 miles in, and then agreeing to be driven back to the starting line to begin the entire 26.2 miles all over again. Your monthly pace might be a little easier, but the total journey is much, much longer. The second major drawback is the cost. A refinance is a brand new mortgage, which means you're paying closing costs all over again. We're talking about appraisal fees, loan origination fees, title insurance, attorney fees, and more. These costs can easily add up to 2% to 5% of the total new loan amount. For Sarah's $390,000 loan, that could be anywhere from $7,000 to nearly $20,000 in closing costs. Often, these costs can be rolled into the new loan so you don't pay out of pocket. But make no mistake, you are paying for them with interest for the next 30 years. That $80,000 in cash might feel more like $70,000 after you account for the fees. Then there's the interest rate risk. We painted a rosy picture for Sarah where rates had gone down. But what if they've gone up? What if her original 4.5% rate is now a distant memory, and the best rate she can get today is 6%? In that scenario, to get her $80,000 in cash, she would have to refinance her entire $310,000 balance from a comfortable 4.5% into a much more expensive 6%. This is a terrible financial trade-off. You're essentially paying a much higher price on your old debt just for the privilege of borrowing new money. In a rising rate environment, the appeal of a cash-out refinance diminishes dramatically. So who is the ideal candidate for this powerful, but potentially costly financial maneuver? It's someone in a very specific situation. First, they need a large lump sum of cash for a specific, high-value purpose, like a major home renovation that will increase the property's value or consolidating a large amount of high-interest debt. Second, and this is critical, they must be able to secure a new interest rate that is significantly lower than their current mortgage rate. The rate savings on the old balance needs to be substantial enough to help offset the negative impact of resetting the loan term and paying closing costs. And third, they should plan on staying in the home for the long haul, at least 5 to 7 more years, to give themselves enough time for the monthly savings to outweigh the upfront closing costs. If you don't check all 3 of those boxes, a cash-out refinance can easily become a financial trap, a long-term solution to a short-term problem that leaves you paying more for longer. It's a total reset for better or for worse. It's powerful, it's all-encompassing, but it's also rigid. You take the cash in one big chunk and you commit to a new loan for decades. But what if your needs are different? What if you don't need $80,000 today? What if you need $20,000 now for a new roof, maybe another $15,000 in a year for college tuition, and the peace of mind of having access to more cash for an emergency down the road? What if you need flexibility above all else? For that, you need a tool that doesn't act like a lump sum sledgehammer, but more like a financial faucet you can turn on and off as you please. This is where we move beyond the world of traditional loans and enter the realm of a revolving line of credit, secured by your home. And that changes the entire equation. So what exactly is this financial faucet? It's called a home equity line of credit, or a HELOC. And if a home equity loan is like a traditional loan, a HELOC is much more like a credit card. A very, very powerful credit card where your house is the collateral. Let's break that down because the difference is profound. When you get a home equity loan, the bank wires a big pile of cash, say $50,000, into your account. The very next month, you start paying back that full $50,000 plus interest over a set term. Simple. Predictable. A HELOC works completely differently. When you're approved for a HELOC, the bank doesn't give you a pile of cash. Instead, they give you access to a pile of cash. They say, okay, based on your equity, you have a credit line of up to $50,000. You can use it if you want, or you can let it sit there. It's up to you. This entire process is split into two distinct phases, and understanding this division is the single most important part of understanding a HELOC. First, you have what's called the draw period. This is typically the first 10 years of the HELOC. During this time, it acts just like that credit card. You can borrow money from your credit line as you need it. You can take out $5,000 one month for a new roof, then $2,000 6 months later for a new furnace. You can even pay back some of the principal and then borrow it again. It's a revolving door of credit. If you need $10,000 for a project, you take out $10,000. You only pay interest on the money you've actually borrowed, not the total $50,000 credit line you were approved for. And here's where it gets even more tempting. During this 10-year draw period, many lenders only require you to make interest-only payments. Let's say you've borrowed $20,000 at a 7% interest rate. Your minimum monthly payment might only be around $116. That sounds incredibly affordable, right? A tiny payment to access a huge amount of cash. This flexibility is the HELOC superpower. It's perfect for situations where you don't know the exact total cost of a project, or when expenses are spread out over time, like a long-term home renovation or paying for 4 years of college tuition, one semester at a time. Why borrow the full amount on day one and pay interest on it for months or years before you even need it? With a HELOC, you don't have to. But every superpower has a weakness. And the HELOC has two massive ones that you must be aware of. The first, and most critical, is the interest rate itself. Unlike the home equity loan, which almost always has a fixed interest rate for the life of the loan, the vast majority of HELOCs have a variable interest rate. This means your interest rate can, and will, change over time. Your rate isn't a number set in stone. It's a formula. It's typically calculated by taking a benchmark index, most often the US prime rate, and adding a margin on top of it. For example, your rate might be prime plus 1%. So, if the prime rate is at 7.5%, your rate would be 8.5%. But the prime rate is set by the Federal Reserve. When the Fed raises interest rates to fight inflation, the prime rate goes up almost instantly. And so does your HELOC payment. That 8.5% rate could become 9.5% or 10.5% in a matter of months. That $116 interest-only payment on your $20,000 balance suddenly becomes $141, then $158. It might not sound like much, but imagine you've drawn the full $50,000. A 2-point rate hike could mean your monthly payment jumps by nearly $100 just like that. You have absolutely no control over it. You are, in essence, strapped to a financial roller coaster that's being driven by the national economy. This is a risk you do not have with a fixed-rate home equity loan. But the variable rate is only the first danger. The second one is even more jarring, and it's called payment shock. Remember those two phases? The draw period and the repayment period? Well, after the 10-year draw period ends, the party's over. The faucet is turned off. You can no longer borrow any more money from the line of credit. And your loan enters the repayment period. During this phase, which is typically the next 20 years, your loan fully amortizes. This means you are no longer making small, interest-only payments. You now have to start paying back all the principal you borrowed plus the interest over the remaining term. Your monthly payment will explode overnight. Let's go back to that $50,000 balance. During the draw period, your interest-only payment at an 8.5% rate would be about $354 a month. That's manageable for many. But the day the draw period ends and the repayment period begins, that loan amortizes over the next 20 years. Assuming the rate is still 8.5%, your new monthly payment would jump to $434. That's an $80 a month increase instantly. And remember, that's if rates haven't gone up. If rates have climbed to 10.5% by then, your new principal and interest payment would be $501 a month. That's nearly a $150 increase from your original payment. It's a financial shockwave that has caught millions of homeowners completely by surprise, potentially putting their budgets and even their homes at risk. So let's put it all on the table. The HELOC is the champion of flexibility. It's the perfect tool if you have ongoing or unpredictable expenses. You only borrow what you need when you need it, and you only pay interest on what you use. The initial payments during the draw period can be seductively low, making it seem incredibly affordable to tap into your home's value. It gives you a sense of security, like a financial safety net, you can deploy at a moment's notice. But it's a tool that demands discipline and a stomach for risk. The variable rate means you are gambling on the future of interest rates. If they fall, you win. If they rise, as they have dramatically in recent years, your payments will rise right along with them. The temptation to use it like a slush fund for vacations or consumer goods can be overwhelming, digging you into a hole of debt secured by the roof over your head. And the payment shock when the draw period ends is not a possibility, it is a certainty. Your payment will go up, and it will likely go up by a significant amount. So we have two very different tools, born from the same source of power: your home's equity. One is a home equity loan, a stable, predictable, one-time lump sum of cash. It's the financial equivalent of a sledgehammer, powerful, straightforward, and best used for a single, well-defined job. The other is the HELOC, a flexible, revolving line of credit. It's the financial equivalent of a sophisticated multi-tool, versatile and adaptable, but with more moving parts and more ways for things to go wrong if you're not careful. One offers certainty, the other offers possibility. One is about planning, the other is about adapting. Choosing the wrong one for your situation can be a costly mistake. So how do you decide? How do you weigh the predictable safety of a fixed loan against the powerful flexibility of a line of credit? It comes down to asking one simple question about your own financial future. And that question is this: am I solving for a problem of certainty or a problem of uncertainty? Your answer to that single question will illuminate the path forward better than any spreadsheet or online calculator. Let's break that down with two very different, very real-world scenarios. First, let's meet Sarah. Sarah is a planner. Her life is a series of well-organized projects. For 3 years, she's been dreaming of a new kitchen. Not just new countertops, a full-gut renovation. Walls moved, new plumbing, custom cabinets, the works. She spent months getting detailed quotes from 3 different contractors. She knows, down to the last penny, that the entire project will cost her exactly $78,000. For Sarah, the cost is not a variable. It is a fixed, known number. She has a problem of certainty. For Sarah, a traditional fixed-rate home equity loan is almost certainly the superior choice. Why? 3 reasons: predictability, discipline, and peace of mind. She applies for a loan for the exact amount she needs, $78,000. The bank approves it, and that money is deposited into her account as a single lump sum. She can now pay her contractor and get the project started. From that moment on, her financial obligation is written in stone. Her interest rate is locked in. If the Federal Reserve raises rates tomorrow or next year or 5 years from now, it doesn't matter to Sarah. Her rate will never change. Her monthly payment will be the exact same for the entire life of the loan, whether it's 10, 15, or 20 years. She can set it on autopay and it becomes a simple, predictable line item in her budget, just like her primary mortgage. This is financial bedrock. It's a fortress built against the winds of market volatility. Furthermore, it imposes a healthy discipline. The money is for the kitchen. It's not a slush fund for a surprise vacation or a new car that catches her eye. The temptation to overspend is removed. She took out a loan for a specific purpose, and the structure of the loan encourages her to stick to that purpose. This is the sleep-at-night option for someone with a clearly defined, one-time financial need. Now let's meet Mark. Mark's financial future is, well, it's a lot cloudier. He isn't planning one big project. He's trying to build a safety net for a series of potential life events. His oldest child starts looking at colleges next year, which means tuition bills could be coming in scattered, unpredictable chunks over the next 4 to 8 years. His parents are getting older, and while they're healthy now, he knows a sudden medical need could require expensive home modifications or care. On top of that, his roof is getting on in years. It's not leaking yet, but he knows a 5-figure replacement is somewhere on the horizon in the next few years. Mark doesn't have a problem of certainty. He has a massive problem of uncertainty. He doesn't know if he'll need the money when he'll need it or how much he'll need when he does. If Mark took out a home equity loan like Sarah, it would be a financial disaster. Should he borrow $200,000 to cover every possible contingency? If he did, he'd start paying interest on all $200,000 from day one, even if the money just sat in his bank account untouched for years. It would be incredibly inefficient. This is where the home equity line of credit, the HELOC, becomes the perfect tool. Mark applies for a HELOC and gets approved for, let's say, a $150,000 line of credit. This doesn't mean he gets a check for that amount. It means he now has access to that capital like a massive credit card secured by his house. For now, he does nothing. He owes nothing. He pays nothing. It's a powerful financial safety net, waiting on standby. Then the first college tuition bill for $25,000 arrives. Mark simply transfers that amount from his HELOC to his checking account and pays the bill. Now, and only now, does he start paying interest, and only on the $25,000 he's actually used. The other $125,000 remains untouched and interest-free. 2 years later, his father has a health scare and needs a $10,000 wheelchair ramp installed. Mark draws another $10,000. Now he's paying interest on a total of $35,000. A year after that, the roof finally starts leaking after a major storm. The replacement is $20,000. He draws that from the HELOC. You see the power here? The HELOC is a reservoir. It's a flexible living financial tool that adapts to the chaos of life. During what's called the draw period, typically the first 10 years, Mark can borrow and repay funds as he sees fit, often only being required to pay the interest each month. It's the ultimate solution for a problem of uncertainty. But this flexibility comes with a hidden psychological trap. For Sarah, her loan is a mission with a finish line. For Mark, his HELOC can feel like a permanent source of cash. The temptation to use it for non-emergencies, a boat, a lavish vacation, a stock market tip from a friend, is immense. Because the initial payments are often interest-only, the true cost feels deceptively low. People get comfortable. They draw a little here, a little there. And for 10 years it feels manageable. Then the draw period ends. The loan enters the repayment period. And this is where the infamous payment shock can hit. Suddenly you can no longer borrow. And your monthly payment is recalculated to pay back not just the interest, but all the principal you've borrowed over the last decade, typically over the next 20 years. And remember, the interest rate is usually variable. If rates have gone up over the last 10 years, your payment could suddenly double or even triple, at the exact moment you lose the ability to borrow more to cover it. It can be a devastating financial cliff. So, it seems like a stark choice. The rigid safety of the loan versus the risky flexibility of the HELOC. But what if I told you there was a third way? A hybrid option that many banks offer but don't always advertise loudly? Many lenders now offer HELOCs with a fixed-rate conversion option. This is a game-changer, and it attempts to give you the best of both worlds. Here's how it works. You have your variable rate HELOC just like Mark. You use it for smaller, unpredictable expenses. But then, a large, defined expense comes up. Let's say you decide to put on a $30,000 addition to your home. You draw that $30,000 from your HELOC. But instead of letting that large sum float on a variable interest rate, you call your bank and activate the fixed rate option for that specific amount. The bank then locks in that $30,000 balance at a fixed interest rate, with a fixed monthly payment schedule, essentially creating a mini loan inside your larger line of credit. Your remaining HELOC availability is still there, and it's still a variable rate line you can draw from for other things. This gives you Sarah's predictability for your big projects, and Mark's flexibility for life's smaller surprises, all in one product. It is an incredibly powerful feature to ask about when you're shopping around. But whether you choose a loan, a HELOC, or a hybrid, you have to be vigilant about one of the oldest tricks in the book: the teaser rate. You'll see ads for HELOCs with jaw-droppingly low introductory rates, 1.99%, 2.99% for the first 6 months. It looks like free money. The trap is what happens in month 7. That teaser rate expires and your rate resets to the fully indexed rate, which is the index like the prime rate plus the lender's margin. That 2.99% can instantly jump to 8% or 9% overnight. If you've borrowed a significant amount during that teaser period, your monthly payment will explode. You must always ask, what is the fully indexed rate today? And what is the lifetime cap on this rate? Ignoring that fine print is like willingly walking into a financial ambush. Choosing the right product is only half the battle. The other half is convincing the bank you're worthy of it. And the metrics they use to judge you might be completely different than what you think. In fact, there's one surprising factor that can instantly kill your application, even if your credit score is perfect. And that factor is a large, undocumented cash deposit. It seems completely backward, right? You'd think a bank would love to see you suddenly have an extra $10,000, $20,000, or $50,000 in your account. It shows you're financially healthy. But to an underwriter, the financial detective whose only job is to find reasons to deny you, that cash is a giant flashing red flag. It's not an asset, it's a liability. It's a mystery they are legally required to solve. You see, thanks to federal regulations like the Patriot Act, banks have a strict duty to prevent money laundering. When a huge chunk of cash appears in your account out of nowhere, their first thought isn't, "Oh, good for them." Their first thought is, "Where did this come from? Is it legitimate? Is it a loan from a friend that we don't know about? Is it from an illegal source?" They need to be able to trace every single dollar you're using for your down payment or to qualify. The money needs to be seasoned, meaning it has to have been sitting in your account for at least a couple of months, usually proven by 2 full bank statements. If your grandma gives you $20,000 in cash as a gift for the house, you can't just deposit it. You need a signed gift letter from her, a copy of her bank statement showing the money leaving her account, and a copy of your statement showing it arriving. Every penny has to have a paper trail. A recent unexplained cash deposit can stop a multi-$100,000 loan application dead in its tracks, no matter how perfect your 800 credit score is. This is your introduction to the world of underwriting. It is not a friendly conversation. It is a financial colonoscopy, and you better believe they're going to look at everything. The underwriter's job is not to help you get a loan. Their job is to protect the bank's money from you. They are trained professional pessimists paid to imagine the absolute worst-case scenario for your life. You lose your job, you get sick, you get a divorce, and then decide if the bank will still get its money back. To do this, they put your entire financial life under a microscope, focusing on 4 key areas. People in the industry sometimes call them the 4 C's of credit: capacity, credit, capital, and collateral. First, capacity. This isn't just about how much you make. It's about how much you make relative to how much you owe. This is your debt-to-income ratio, or DTI, and it is the single most important number in your application. To calculate it, the bank adds up all your monthly debt payments, your car loan, your student loans, your credit card minimum payments, and the proposed new housing payment, including principal, interest, taxes, and insurance or PITI. Then they divide that total by your gross monthly income before taxes. So, let's say you make $10,000 a month. Your car payment is $500, student loans are $300, and credit cards are $200. That's $1,000 in existing debt. Now let's add the new mortgage payment, which we'll say is $3,300. Your total monthly debt is now $4,300. Divide that by your $10,000 income, and your DTI is 43%. For decades, the gold standard was a DTI no higher than 36%. These days, with housing costs soaring, lenders have gotten more flexible, often allowing up to 43%, sometimes even 50% for borrowers with high credit scores and a lot of cash in the bank. But go even 1 percentage point over their limit, and the computer says no. It's a hard and fast rule. This is why co-signing a $15,000 car loan for your kid right before you apply for a mortgage can be a catastrophic mistake. That new $300 monthly payment could be the one thing that pushes your DTI over the edge and gets you an instant denial. Next, the underwriter scrutinizes your credit, and they look at so much more than just the 3-digit score. They pull what's called a tri-merge credit report, getting data from all 3 bureaus, Equifax, Experian, and TransUnion. They're not looking for perfection. They're looking for a story of responsibility. A 790 credit score with 130-day late payment in the last year is viewed as far more risky than a 740 score with a flawless 7-year payment history. They look at your credit utilization. Are you maxing out your cards every month? That's a sign of financial stress. They look at the age of your accounts. A long history of managing credit well is a huge plus. And they look for recent inquiries. If you've suddenly applied for 3 new credit cards and a furniture store loan in the last 2 months, it sends a signal that you might be about to take on a mountain of new debt the second the mortgage closes. The third C is capital, which is just a fancy word for cash. The bank wants to see that you have money left over after you pay your down payment and closing costs. These are your reserves. This is your emergency fund. It's their proof that if you lose your job a month after closing, you won't immediately default on the loan. The standard is to have enough cash in the bank to cover anywhere from 2 to 6 months of your full mortgage payment, that PITI number again. And as we discussed, this cash has to be seasoned, can't just appear out of thin air. Finally, and this is a big one, is the collateral. That's the house itself. The bank is lending you hundreds of thousands of dollars, and the house is the only thing securing that loan. If you stop paying, they take the house. So they need to be absolutely certain that the house is worth what you're paying for it. This is where the appraisal comes in. The lender hires an independent, third-party appraiser to go out to the property. The appraiser measures the home, notes its features and condition, and then compares it to at least 3 similar homes that have recently sold in the immediate area. These are called comps. Based on those comps, they assign a professional opinion of value to the home. If you've agreed to pay $500,000 for a house, but the appraisal comes in at only $480,000, you have a problem. The bank will only lend you money based on the lower of the two values, the purchase price or the appraised value. That $20,000 gap? That's on you to cover in cash, or you have to try and renegotiate the price with the seller. A low appraisal can kill a deal instantly. Now, this entire invasive process is at its most intense when you're getting a primary mortgage. But what about a home equity loan? Is it just as brutal? The answer is yes and no. The underwriting for a home equity loan or a HELOC is still very thorough. They will still pull your credit, verify your income, and calculate your DTI. But it's often a slightly smoother, faster process for one critical reason: lien position. When you get your first mortgage, the lender is in the first lien position. This means if you default and the house is sold at foreclosure, they get paid back first. Any other debt secured by the house is secondary. A home equity loan lender is in the second lien position. They only get paid after the primary mortgage lender is made whole. This makes their loan inherently riskier. Because of this, you might think they'd be more strict, but it's a bit more nuanced. They are extremely focused on the amount of equity you have. They're less concerned with the total value of the home, and more concerned with the size of the cushion between your first mortgage and the home's total value. If you have a $500,000 home and a $200,000 mortgage, there's a massive $300,000 equity cushion. A lender feels very safe giving you a $50,000 home equity loan because even if the home's value drops significantly, there's still more than enough money to pay everyone back if you default. The process also gets much easier if you get the home equity loan from the same bank that holds your primary mortgage. They already have your payment history. They already have the original appraisal on file. They already know you, which can streamline the paperwork significantly. But make no mistake, whether it's a mortgage or a home equity loan, you are walking into a gauntlet designed to find your weaknesses. I once saw a couple, both doctors with a combined income of over $300,000 and near-perfect credit, get denied for a simple refinance. Why? 3 weeks before they applied, they opened a new credit card to get the airline miles for a vacation. That small act dropped one of their credit scores by 15 points, just enough to fall below the threshold for that specific loan program. They had to wait 6 months for the score to recover. The key takeaway is this: for the 2 to 3 months leading up to any loan application, you need to become a financial ghost. Don't apply for new credit. Don't make any large, unusual purchases. Don't change jobs even for a promotion. And for the love of God, don't deposit a big bag of cash. Keep everything as boring and predictable as possible. Surviving the underwriter is the biggest hurdle. But even after you get the approved stamp, you're not out of the woods. The real danger lies in the documents you sign at closing. There are hidden clauses and fees, perfectly legal by the way, that can turn your dream loan into a financial nightmare. And one of them, a single sentence buried on page 47, could give the bank the right to demand the entire loan back immediately. That sentence is called an acceleration clause, and it's one of the most powerful and potentially devastating tools a lender has in their arsenal. It's a financial tripwire. You stumble and the entire loan comes crashing down on you. So what triggers it? The most obvious is failing to make your payments. You miss a few and the bank doesn't just want the payments you missed. They can legally activate this clause and demand the entire remaining balance, $200, $300, $400,000 due right now. But it gets far more subtle. Did you know that letting your homeowner's insurance lapse can trigger it? To the bank, an uninsured property is a massive risk. If it burns down, their collateral is literally smoke. So if you miss an insurance payment and your policy is canceled, the bank can see that as a violation of your loan covenant and call the entire loan due. The same goes for failing to pay your property taxes. The county can put a lien on your home that is superior to the bank's lien, meaning the county gets paid first if you foreclose. Banks hate being second in line for anything. So, if you fall behind on taxes, boom, acceleration clause. It can even be triggered if you transfer ownership of the property without the lender's permission, even to a family member or into a trust for estate planning. This is known as a due on sale clause, which is a type of acceleration clause. The logic is that the bank gave the loan to you based on your credit and financial situation. They didn't agree to be in a contract with your cousin or your newly formed LLC. So the moment the title changes hands without their written consent, they have the right to call the loan. Think about the sheer impossibility of that demand. If you had hundreds of thousands of dollars just sitting around, you probably wouldn't have needed the loan in the first place. For 99% of people, an activated acceleration clause is a direct path to foreclosure. It's the point of no return. And this isn't some shady back-alley practice. It is standard language in virtually every mortgage and home equity loan document in the United States. It's the bank's ultimate protection, and it highlights a fundamental truth. You don't truly own your home until that loan balance is zero. Until then, you are a tenant of the bank and you have to play by their rules. But the acceleration clause is just one monster hiding in the fine print. Let's talk about another one, the prepayment penalty. It sounds completely backward, right? You're being punished for being financially responsible and paying off your debt early. But it's real. Lenders make money from the interest you pay over the life of the loan. A 30-year mortgage is a 30-year revenue stream for them. If you pay it off in 5 years, you've just cut off 25 years of their projected profits. So they build in a penalty. It might be structured as a percentage of the remaining loan balance, or maybe 6 months' worth of interest. On a $300,000 loan, that could be a surprise bill for $5,000, $10,000, even $15,000 just for the privilege of paying them back what you owe ahead of schedule. These penalties are less common in standard mortgages today thanks to regulations, but you still have to watch for them, especially in non-conventional loans and some home equity products. It's a clause designed to keep you in debt and in their pocket for as long as possible. Then there's the labyrinth of the escrow account. Your monthly payment isn't just for the loan. It includes 1/12 of your annual property taxes and homeowner's insurance. The bank holds this in escrow and pays the bills for you when they're due. Sounds convenient. But here's the trap. The bank only estimates what those bills will be. What happens when the county reassesses your home's value and your property tax bill jumps by $1,000? What happens when your insurance premium goes up by $600 because of a hurricane on the other side of the country? The bank pays it. But now your escrow account has a massive shortfall. To make up for it, the bank will jack up your monthly mortgage payment, sometimes by hundreds of dollars, to cover the shortage and to build a bigger cushion for the next year. You thought you had a fixed-rate loan, but your payment just shot through the roof, and you had absolutely no control over it. Now let's tie all this back to the central question. Mortgage versus home equity loan. Which one is right for you? Now that you understand the mechanics, the risks, and the fine print, we can build a decision-making framework. It all comes down to your specific goal. Scenario 1, you're buying a home. The answer is simple. You need a primary mortgage. Your main decision isn't mortgage versus equity loan, but which type of mortgage. A 30-year fixed gives you the lowest possible payment and stability. A 15-year fixed will build equity lightning fast and save you a fortune in interest, but with a much higher monthly payment. You're choosing your financial timeline. Scenario 2, you're renovating your home. This is the classic battleground. Let's say you want to add a $70,000 kitchen. You know the exact cost from a contractor. A home equity loan is perfect. You get a lump sum of $70,000 at a fixed interest rate. Your payments are predictable, and you know exactly when it will be paid off. It's clean. But what if your project is more open-ended? Maybe you're redoing the backyard over the course of a year, buying materials as you go. You don't need all the money at once. This is where a home equity line of credit, or HELOC, shines. It's a credit card backed by your house. You get approved for a certain limit, say $100,000, and you can draw from it and pay it back as you please during the draw period, usually 10 years. The danger? The interest rate is almost always variable. It might start low, but it can adjust upwards, sometimes dramatically, leaving you with a payment you can no longer afford. You're trading predictability for flexibility. Scenario 3. You want to consolidate high-interest debt. This is the most tempting and the most dangerous use of home equity. You've got $40,000 in credit card debt at 22% interest. A home equity loan at 8% seems like a genius move. You'll save thousands in interest. And mathematically, you will. But you've just played a very high-stakes game. You have transformed unsecured debt into secured debt. If you default on your credit cards, you get nasty calls and a trash credit score. It's painful, but they can't take your house. The moment you pay off those cards with a home equity loan, that $40,000 debt is now attached to your home. If you lose your job and can't make the payments on the equity loan, the bank won't just send you a mean letter. They will start the foreclosure process and sell your home to get their money back. You've traded a financial problem for a potential homeless problem. This strategy should only be considered if you have ironclad discipline and have fixed the spending habits that created the debt in the first place. So, what is the single most important takeaway from all of this? It's that a loan document is not a formality. It is not an "I agree to the terms and conditions" checkbox you click online. It is one of the most significant contracts you will ever sign. It dictates the terms of your financial life for decades and gives a financial institution power over the roof above your head. The goal of this entire breakdown was not to scare you away from borrowing. It was to arm you with knowledge. It was to transform you from a passive participant into an active, informed consumer who understands the game. The truth is, the bank has a team of experts and lawyers who wrote these documents to protect their interests, not yours. Your single best defense? Read every single word. And if you don't understand it, don't sign it. For a few $100s, you can hire an independent real estate attorney to review your loan documents before you close. People will spend $1,000 on a home inspection to check for a leaky faucet, but will blindly sign a $500,000 loan document they haven't read. Paying an attorney is the cheapest insurance policy you will ever buy. They can spot a prepayment penalty, explain the exact triggers for your acceleration clause, and translate that 80 pages of dense legalese into plain English. Understanding the difference between a mortgage and a home equity loan is more than just an academic exercise. It's about understanding the tools at your disposal, and more importantly, understanding the risks that come with them. Your home is your sanctuary, but it is also your single greatest financial asset. Treat it that way. Don't just sign your future away. Understand it, question it, and own it.